Hello guys and welcome to another video. In this video I'm going to be going over some data that isn't I would say that well known, but I would say is very powerful for your trading process. If you found this channel, if you subscribe to this channel, or if you're finding yourself watching this video, you probably have already heard of the ISM and what it is. I won't be going over what the ISM is in this video that's been covered to death by many different people on the internet. But those that do know the power of the ISM know that if you can get a leg up on the ISM, that would be huge for trading in FX, commodities, equities, or bonds. So my question to you, as we've got here, the Matrix meme. What if I told you I can predict the ISM? Many of you will be thinking, yeah, right, there's no way you can do that. Well, maybe there is. And that's what I'm going to aim to show you with this presentation. So it is a PowerPoint, so I'll be roughly following these bullet points here. So we got short-term leading indicators, long-term leading indicators, how to use them, a summary, and then some bonus data at the end. So Um, sorry to tell you guys, not all leading indicators are born equal. There are things called short-term leading indicators. You kind of know these, the ISM. They give you like 1 to 3, maybe 6 month lead on the market. And then there are longer term leading indicators. Hopefully you don't know these. If you do, then it's kind of pointless watching, but stick around. I'm sure you'll learn some extra tips and tricks here. Um, so these longer leading indicators can give you 8 to 10 months and possibly 18 month on economic data. So what is an SLI? So a short-term leading indicator. These are loosely those PMIs that we've heard of, ISM, NMI, IHS market PMIs. To a certain degree, permits and sentiment, but those are, I would say, a bit longer leading. And then you've got the IHS PMIs, including the flash PMIs, if you haven't heard of them. So there's a certain amount of PMIs for Germany, France, Australia, United Kingdom, and America, Europe, that IHS produce that come out a couple of weeks before the official PMI, and these are called flash PMIs, and they're 80% of a initial release. And the markets move on those, and usually, if you see when the market PMIs come out and nothing happens, it's because they've already priced it in from the flash PMI. Or another PMI that the US has is, or a short-term leading indicator one, is the Chicago PMI, which is a bit more volatile than the ISM, but still comes out a day or two before the ISM. I know a day or two isn't really that much or helpful, but it does help you underscore and confirm the ISM direction. Potentially, some people think that it leads the ISM by a couple of months. I'm doubtful on that, but it does have a good match to the ISM. Then there's something called regional PMIs for the United States. And using some maths, very simple maths, it's not going to be very difficult. You can get around a 96% match to the ISM with a minimum of 2 week lead, potentially by a couple of months as well, as you'll see later on. And so that will be the first indicators that I'll show you that actually predict the ISM. So the Fed is not just one organization. Um, Obviously, when you're monitoring a gigantic country like the United States, one organization based in one state can't do that. It's impossible. So it's broken down into roughly 10 regional feds, rather, across the United States, 5 of which report PMIs for their regions on a monthly basis before the ISM is released. It's not on the same scale of 50 and above, and 50 below is contracting, and 50 and above is, expanding. Instead, they have their own scales, and they have negative numbers and positive numbers to denote contraction and growth. Um, these are the earliest PMIs to report in the United States, and they give you a leg up on the ISM. So there's 5 of them, and they're listed in front of you. You've got the New York Fed, the Philadelphia Fed, Richmond Fed, Kansas Fed, and Dallas Fed. And some have been established a bit longer, and some haven't. Um, so if you can get all of that data, which you can, obviously this is on this YouTube channel, you know where to get the data from, Metastock Xenith. If you haven't signed up already, please do. Um, so once you have that data, if you just average the 5 of them, you will get a figure, and then this figure can be plotted against the ISM releases. Um, so you take the average of the 5, like I've just said, give you a tweak lead, but after about 3 of them, you know which way the ISM is going to go. So then you can have a more of a 3-week lead on the ISM, or maybe longer. And we're really looking at a trend change, because a trend change is the most important. Picking peaks and troughs are where you can really get the most amount of returns by starting or exiting and changing your positions or your portfolio. When regional PMIs come out, the markets move. I've seen this in real time, even on a 1-minute chart for all the different asset classes that exist. So if you compare them, this is what you get. So we've got the regional PMIs in orange, and we've got the ISM in blue. Why haven't I gone before 2001? Because you didn't have all 5 of the regional feds reporting. Prior to that, you had about 4 or 3 and so on. So from 2001 onwards, you have all 5 regional feds. And you can see it tends to lead always on the ISM, either topping out or bottoming. And here, crucially, in the great financial crisis, it led for a good couple of months before the ISM catched up. There's no time where it's given a kind of false reading. It can tell you it might have swung initially down a bit lower, but the trend was definitely broken then, coming out of the GFC. And it also told you a good time to confirm to get going back in 2016, when many people were calling for a recession back then. But no, the regional feds were saying we're on a rebound, took off, and then also told us things were going to go worse later on in the year. So that can give you a real good leg up on the ISM. They do have comments, and all the data and everything is in the Metastock Xenith platform. So of the ISM, there are leading parts and lagging parts. These are your leading parts and lagging parts. Again, all the data will be in Xenith. Here's another regional Fed. This is the Richmond Fed Services. So the Richmond Fed has one for manufacturing and another one for services. And it's very volatile. The blue line is the actual Richmond Fed Services, and then the kind of brown line is the NMI. But it predates the NMI, and if you do a 4-period moving average, it leads the NMI. And you can see that clearly throughout the entire process. So if you just get the trajectory right, which is what we're really interested in, if we're going higher or lower, that would give us a leg up on the NMI as well. So that's a fantastic indicator for that. So here's a summary of the indicators so far that I've gone over, and all their RIC codes, which are available on Metastock Xenith with the referral code down below, 3 months for the price of 1. And you can build out spreadsheets that will display charts like I've discussed, and for also the IHS, market PMIs, and the other more well-known PMIs, or short-term leading indicators as we now know them as. So, okay, we've been over the short-term leading indicators. If you knew them, great, fantastic. The longer-term leading indicators, I'm pretty certain you probably wouldn't have heard of, or at least made the connection between that and the indicators and the economy. So, have you ever wanted to know how much longer the ISM will continue to expand or contract? I mean, the short leading indicators are great for telling you where we are the next month or two, but what about the longer term, the next 18-month picture? Well, now you can. Money supply data is very, very important, and then also the bond yields. Essentially, a bond is when you're buying a bond or selling a bond, you're making a statement on whether you have faith in the forward-looking economy or whether you don't. This is easily Googled. Just Google for bonds and what they mean and why people buy them and when they sell them, etc. And money supply, obviously, if you have more money, yeah, it's going to filter its way into the stock market sooner or later. So keeping an eye on this type of data will show you which way markets are going to go eventually. So here we have some focusing on the United States, because the United States is still the biggest economy in the world. So the United States money supply on a year-over-year basis versus the ISM on a year-over-year basis. And so the green shaded area is the money supply, and then the black line is the ISM year over year. And you can see that if the green line is leading, then the peaks that we have here, as I've kind of labeled the most recent business cycle, it showed well in advance there would be a massive uptick in the ISM over here. Then it troughed back down. This showed this would be shown by the money supply also troughing way below, and then it also picking up, then resulting in a pickup in the ISM, and then it troughed back down, troughing back in the ISM, and so on and so forth. And you can look at this all the way back. Pause the video just to make yourself for your eyes to adjust. With some Excel trickery, I'm sure you could adjust the time lengths on this, that, and the other, but I've kept it the same time length, so no one can say, oh, you've just adjusted the time length for that. It generally does work out going back to since when money supply began. You can look at M1, M2, or M3 from various different countries, like I've stated, Europe and China and US. Mainly the US is the most important, but the other ones also do play a part in the so-called QE wars that are happening for the last 10, 15 years or so. So here's China's M1 money supply versus the S&P 500, and you can see whenever it troughs, there is a trough in the market, and then late when there's an upsurge, the market rips, and so on and so forth, as you can see with the arrows. So that's that. Now this is where things can get a bit tricky, so do pause the video if you need to spend a bit longer time looking at the charts, but I can assure you this is something that will be invaluable for you. The US 2-year bond year over year inverted versus ISM. So this scale over here is the bond yields 2-year year over year inverted, so positive at the bottom and negative at the top. And over here we have the ISM, and this is going back to 77. So I am saying that this can now predict the beginning and end of cycles around 18 months to 24 months before before the end or the start of a business cycle comes. So you can see here we had a massive troughing of the 2-year inverted year over year, and if we forward just a little bit of time, then the ISM came crashing down. Similarly, we had the bond yield inverted, screaming much higher, and then we came back out of it with a huge PMI resurgence. And in between, it doesn't do much because of the whole QE experiment. And then also, it tends to give you a lead on the beginning and end of cycle. Here, it was screaming that we're coming into some really bad economic times, and that's what happened with the ISM at that point when I created this graph. And then it says later on we will come screaming back, as usually what happens when we have an end of cycle. We tend to have a massive rebound back up, and you can see this previously as well. These two correspond to the ISMs over here. This bottoming corresponds to the dot-com crash, dot-com recession rather. And similarly, once your eyes adjust to seeing the peaks moving across, you can see how powerful this is. That's great for seeing the beginning and end of business cycles, but what about in between? If you could see ISM cycles, that would be great. So here I've substituted the 2-year for the 10-year, which is the most liquid bond bar none around the world. And you can see, once your eyes adjust again, inverted bond yields on the left-hand side and the ISM scale on the right-hand side. You can tell that it's going to give you a very accurate measure of ISM swings. It won't tell you exactly how high the ISM is going to go, but all we really need to know is when is it changing the trend, and then that's when you can position yourself appropriately. So you could see, again, it doesn't look like much in terms of time left, but this is around an 18-month, 24-month lag between an upsurge, which it correctly predicted, and then later on it correctly predicted a decline, which was then shown there, and so on and so forth. So you had this peak over here, followed by decline, double peak in the ISMs touching, and that's exactly what we had. We had a protracted high 50s period of the ISMs in 2018, and then it finally came down, and then we have now starting to see the weakness in the ISMs with the bond yields. And if you go and create the graph yourself using the data that I'm showing through Metastock, you'll be able to see the exact same things that I am seeing in Excel. And once your eyes have adjusted to this chart, you'll start to see how powerful this can. It tells you every inflection of the ISM cycle. So there could be multiple ISM cycles within a business cycle, and positioning yourself for that can lead to great gains for your trading account. So summary of the LLIs. So we have US, Europe, and China money supply data. Just look at the ones you want to, which ones you're interested in, whether that's M1, M2, or M3, and then you'll be able to see 8 to 10 months. So it's a longer leader than the short-term leading indicators, and then the inverted yield curves will show you where where you are on an 18-month, possibly 24-month time frame. This will give you greater knowledge, greater understanding of where we are in terms of the ISM cycle, and also timing of the market. Sometimes the best thing, the best quality to have in trading is timing, and this will give you that that ability, and it will also allow you to hold on to winning trades longer term. If you know that the ISMs or the economy is just going to keep expanding, then you might as well just hold on to your winners. So does this also work? So the inverted bond yields that we've been going on, does it work for other regions? Of course it does. So here's EU bond year over year versus the market PMI. Again, it shows the inflections, but at a greater rate. 10-year, I don't seem to like it too much, but what I do like is when I compare the German 5-year bond year over year inverted again on the right hand side, and then the ESI for Europe. Obviously, Germany is the powerhouse for Europe, and you can see that the inverted bond yield correctly predicted major sell-offs, contractions in the ESI and major upsurges in the ESI, as I've pointed out with a few of these red arrows and going back since the inception of the ESI. So there we go for Europe. Does it work well for China? Yep, the 2-year seems to work really well, but I also like the 5-year. 5-year seems to show accurately when there will be major weak points in the Chinese economy 18 months or so in advance of the PMIs. So that's great. So here are the RIC codes for the different bond yields that you'll need to retrieve the data from Metastock into Excel. So have a mess around with that, or build the sheets out for yourself. Play around with things. Have a look at the different RIC codes that are available. And for the different bond yields, and have a look at how they correspond to the PMIs. You'll come to the same conclusion as I have, that they work very well, and they'll be able to help you in your trading process. So are there any other PMIs then? Well, yes, there are. IHS Markit produce sector PMIs for all sectors. So sector PMIs are basically think technology, staples, retail, mining, as I've written here, but for different regions, the United States, Europe, and Asia. As a result, you can see which sectors are growing and contracting, which ones are performing better than others, and this is fantastic data to have. However, you don't get this data with a Metastock Xenith. You don't even get it with a Bloomberg or a Thomson Reuters terminal. Or I guess it's called a Refinitiv terminal now. Instead, you have to pay directly to IHS Markit. However, what IHS Markit do allow you to do is and they allow you to go to their website, which I will just do right here. Plug it in, and here you get all the releases for all the different PMIs that are produced. So we'll do a control find. And we'll look for sector. There's the global sector PMI. There's Europe's one. There's Asia's one, and United States. Let's look at United States. So I've just clicked on that, and should open. Not sure why it hasn't opened there. Right, let's try this. Control find sector. And United States. Here we go. There we go. And here you can see the sector PMI for the United States. Healthcare seems to be doing well. Everything else seems to be contracting. Technology, how that's doing, and a highlight of what's happening within the different sectors within the United States. So that's pretty useful as well. Um, so you can just check that every so often, find out when the releases are coming, put a note in your diary, and have a look at which sectors are contracting and expanding and whether that impacts your trading process. So on to the next slide. How to use LLIs and SLIs? Well, fairly obvious, really. You use the long leading indicators to see how far out we are from a trend change or what you wish to, what is coming up. Use the short-term leading indicators to confirm that viewpoint, and then maybe a couple of coincident datas if you want to go that far. Most people just trade off of the long-term leading indicators data, um, as that's the one that's everyone's watching. And then you can place your trades as you so choose to fit, whether it's risk on, risk off, defensive, cyclicals, whichever way you wish to trade. So, summary. Now that we have the SLIs and the LLIs, we can predict inflection points in data. So you shouldn't be caught off guard. Once the ISM cycle inflects, the new direction typically lasts 18 months to 2 years. Um, we now know when to deploy capital in risk on and risk off environments. These indicators, in my opinion, should add a lot more gains to your trading accounts. They don't necessarily say that the market's going to become crashing down or that there will be a recession or anything like that. Part of predicting that is, well, it's very difficult. You might need an exogenous shock to the market as well. Um, but it's more of a case of the economy is slowing down. If the economy is slowing down, then you may wish to take some profits or redeploy your capital in your portfolio a bit differently than the way you have currently set up in, say, more cyclical things. And if the economy is speeding up, then you would want to put more capital into more, say, riskier bets. But that would be entirely up to you, your risk tolerance, how you wish to trade, etc. So here is some special bonus data. The blue line should look fairly familiar, that's the ISM. And then you have the red line, which seems to lead the ISM on every upswing and downswing and has got every recession correct since the 1970s. Um, so what is this indicator then? The red line is the conference board measure of CEO confidence. So if you just Google that, you'll find the data. It's fairly easily found. It's a quarterly indicator, so it's in between an LLI and an SLI. So is it an MLI? I don't know. This is not a PMI. It's the equivalent of consumer sentiment indicators for the United States, but for US CEOs. And these CEOs are from the Fortune 1000, so they're the best CEOs in the world across manufacturing and services industries. Um, the report also has qualitative statements, and these businesses, being the top 1,000 businesses, their businesses are not just within the United States, they expand globally. So it's a real good measure of what's happening in the entire world. And like I said, it predicts every single recession since 75. So it's a great indicator to watch out. But do bear in mind, it is a quarterly indicator and it does predict things well in advance. So the market still has the potential to go up or down in between that time before ultimately the data is proven correct. So just to really hammer home the message, here it is leading the NMI, both this swing down and this swing down. When the consumer sentiment was saying everything was fine during the dot-com, the CEOs were not having it. They were not happy about that, and there they are going down. Same with building permits. So again, building permits went sideways, but the US CEOs were well up on it, and they were trended earlier for all other short-term leading indicators. And even when I compare to the regionals, so when I've averaged out the regionals, the blue line here, it still leads the regionals. So it's showing that we've got some way to go still at the time of recording this. So here I have a summary page of just 50 plus leading indicators which are all available on Metastock Xenith, as that's what the channel is about. And you can organize all your data through there as well. You can export it all into Excel, and with these 50 or so plus indicators, you should be okay for monitoring the world, if not the most important parts of the economy, the most tradable ones anyway. So that being Europe, United States, and China, and different ways to express your views through either equities, bonds, forex, or commodities as a result of that. So that's the presentation, guys. Hopefully you found that helpful, um, and hopefully this has added some serious value to your trading process. If you did like the video, do like the video, do share the video, do subscribe to the channel, and also if you haven't yet signed up to Metastock Xenith, do check out my other videos on the channel, but also do use the referral link in the description below. 3 months at the price of one with that link, and I will see you in the next video, guys.